Ladies and gentlemen, welcome. I'm George Kiadopoulos, Director of the Institute of Finance and Financial Regulation. Welcome to the IFFR Conference on Asset Management for Occupational Pension Funds. So we have a wide international audience, so good afternoon to Europe and good evening to Asia, and good morning to US and Canada. So as you may know, IFFR is an international research center which bridges the gap between academic research and the industry. It runs under the auspices of the Department of Banking and Financial Management of the University of Piraeus, which is a leading department in finance in Greece. And it is based on a team of distinguished academics and professionals from leading universities and institutions. Before introducing our first speaker, may I thank our sponsors. So our gold sponsors, Alpha Asset Management and PCS. Our silver sponsors, Alpha Trust, Iolcus Investments, Piraeus Asset Management, and Systemic. And may I also thank our media partners, Athena, Euro Today, Finance Pro, Economiki, Business File, Nafteboriki, Next Deal, Savvy Investor, and C'est La Vie. We view our sponsors as partners, and we build long-term relations with them. So once again, thank you very much. Last but not least, may I thank the IFFR team, and especially Despina Kontopoulou, as well as the conference co-organizer, Mr. Theodore Economou, who you will have the chance to see him more tomorrow. So without further delay, may I introduce our first distinguished speaker, Mr. Didier Miguel. Didier is the head of Insurance and Pensions Unit at the European Commission since 2019. He has a very rich experience. He's in charge of Solvency II review, and he represents the European Commission at IOPA, at the Board of Supervisors. He's with the European Commission since 1994, so a very long time, and he has held really crucial posts in the European Commission, serving as deputy head of the Asset Management Unit and as head of the Accounting and Financial Reporting Unit. He has also served to the cabinet of Commissioner Michel Barnier. So he's really a live history of what is going on at the European Commission. So Didier, thank you very much for accepting the invitation to speak in our conference, and the floor is yours. Thanks once again.
Thank you very much. I hope you can hear me well. That's the traditional question now for these type of events. Okay, fine. So, ladies and gentlemen, dear Professor Skiadopoulos, thank you very much indeed for the opportunity to say today a few words of introduction to your conference and to present you the current initiatives of the European Commission in the pension area. As we know, Europe is facing a demographic crisis, aging societies, longer life expectancy, shrinking working population, changes in labor markets are associated with a dramatic increase in the number of pensioners. The consequence is greater pressure on public finances and weaknesses in the state pensions amid a prolonged period of low interest rates and low growth. These developments threaten the long-term performance of pension systems and the adequacy of pensions. Pension policy is primarily a member state prerogative. However, considering the economic importance of the issue, the European Union can play an important role to address these challenges. First, by providing comparative analysis of the situation at EU and national level of the adequacy of the national policies. Second, by leveraging on the single market to foster the development of occupational and private pension funds that are able to propose useful complement to the public system. Regarding the common analysis of the situation of the different national systems, the Commission publishes every 3 years, together with the Social Protection Committee, a report on pension adequacy. The Pension Adequacy Report 2021 was issued in June this year. It clearly shows that poverty in old age has increased again and now stands at 18.5% on average in the EU. 16 million older people were still at risk of poverty or social exclusion in the EU 27 in 2019. Looking ahead, the report warns against a further fall in pension levels if nothing is done to increase the financing of the systems. In the context of the 2020 Capital Market Union Action Plan, the Commission has taken additional initiatives to increase awareness about the pension gaps and support EU citizens in the preparation of their retirement. These measures will also be an important step to help Member States reform their national pension systems by supporting transparency and developing good practices. In that context, the Commission mandated EIOPA to give some advice on 2 points. First, EIOPA were asked to identify the relevant data and methodology for developing pension dashboards with indicators. These dashboards will strengthen the monitoring of pension adequacy in the Member States by providing easy-to-read, comprehensive, comparable and up-to-date information. Secondly, EIOPA worked on best practices for the setup of national tracking systems that facilitate citizens' access to individualized pension information and raise citizens' awareness as to their future retirement income. We have now received EIOPA's input on these 2 initiatives and will discuss the results with the Member States and the possible follow-up. Let me now move to the contribution of the single market. As mentioned before, considering the pressure imposed on them, it is our view that state pension systems should be complemented with additional high-quality, safe, and cost-effective supplementary pensions. This represents a necessary and important step towards ensuring an adequate retirement income. Occupational retirement provision has proved to be a well-established and successful tool in many Member States. It can reduce the burden on national pension systems and ultimately provide a large group of employees with a safer and higher pension income. The Iop Directive provides a minimum set of common rules and standards for occupational pension institutions in the single market. The directive was revised in 2016 to facilitate cross-border activities, improve the corporate governance of institutions, and strengthen the information rights of members and beneficiaries. We are still in the process of assessing the way this directive, the so-called Iop 2 directive, was transposed by the Member States. This process has taken more time than we hoped. It is therefore difficult to assess whether the review has been a success or not. In that context, it will be quite difficult for the Commission to issue a formal review of that directive by 2023 as originally planned. We expect quite some delay in that process, unfortunately. But we will certainly come back on this important piece of law in due time, starting with a mandate to EIOPA in the course of next year. In that context, I would also like to mention the results of a study we commissioned to examine best practices of so-called auto-enrollment systems. The study was published at the end of November. These schemes ensure that employees get access to occupational pension schemes in an automatic fashion as part of their employment package. They present the advantage of increasing the take-up of such schemes compared to situations where this would be purely voluntary. We will soon discuss the results of that study with the member states. It is, however, much too soon to envisage any concrete follow-up. This remains quite a sensitive matter. Moving now away from occupational pensions, allow me to say a few words about personal pension products. These products can also represent an important complement to public pensions if they are high-quality products that are easy and safe to invest for ordinary people. Pan-European personal pension products can play an important role in this respect. This is in that spirit that the Commission presented the PEP proposal in 2017. The PEP regulation was agreed in 2019 and is now reality. It is an important milestone on the road to addressing the pension gap and achieving a pan-European market for personal pension products within the Capital Markets Union. The PEP has a big potential as it will offer savers across the EU a new pan-European option to save for retirement. They will benefit from a simple, cost-effective, flexible and portable product accompanied with strong consumer protection rules, including a 1% cap on costs for the basic PEP. The PEP regulation goes live on 22nd of March 2022, as it begins to apply 12 months after the publication of regulatory technical standards adopted by the Commission. We hope it will be a success and count on all actors, the industry, the supervisory community in particular, to make it a success. The Commission will play its part in this process, of course. Ladies and gentlemen, these are the most important initiatives taking place in the field of pensions at EU level. I hope this short presentation provided you with a good overall perspective on this important issue and will inform your discussions. I would like to thank you very much for your attention and wish you a great conference. Thank you.
Thank you very much, Didier. Very informative and stimulating. I think we're going to have a 2 days conference where the speakers are going to build on this information. So may once again, thank you very much for your participation. And may I move on now to our first panel and the moderator. Before doing this, may collectively thank all our speakers and of course our audience. For the audience, may I kindly remind you that you are more than welcome to submit questions. You can do this electronically, and as soon as the first session is over, we're going to have a Q&A where we're going to transfer your questions to the speakers. Each speaker is going to have 15 minutes, and once all 3 speakers have finished, then we will discuss your questions. So feel free to submit questions. So may I move on to the first session, which is going to be chaired by Professor Nikos Tessaromatis. Nikos is Professor of Finance at the DEC Business School, and he has a rich career, both academically as well as professionally. Before joining DEC, he had held positions in Warwick Business School and in Alba Business School. He has also taught at Yale University. On the professional front, he has served as a CEO of DEC Asset Management and as a Director of Investments at ATEF Finance, as well as Head of Research at Gardmore Investment. So Nikos, thank you very much for joining us, and you are the boss now.
Thank you, George. Thank you very much. A very warm welcome to everybody in today's track record and development session. I am delighted to present to you three very experienced presenters in the field of public and occupational pension fund management and pensions regulation. In terms of presentation timing, George did say that each presentation will be 15 minutes. I will give a warning to each presenter 2 minutes before the end of the presentation. At the end of the presentations, there are available 30 minutes for questions. So I will encourage participants to use the chat box and submit their questions. I will collect them and put it to our presenters at the end of the three presentations. Our first presenter is Martin Vos. Martin is Chief Operating Officer at Ortec Finance, a leading advisory firm in pensions and insurance. Martin is also responsible with advisory and modeling work to pension funds, insurers, and sovereign wealth funds. He has advised over 300 owners, asset owners, mainly large pension funds and sovereign wealth funds. He specializes in risk management, asset liability management, and investment consulting for both defined benefit and defined contribution schemes. So Martin, the floor, or rather the screen, is yours.
Thanks a lot for the introduction, and thanks a lot for the opportunity to share ideas and thoughts. And to do so, let me check if I can share my screen and everything runs smooth. I think the screen is now there. And maybe as a starter, as was just explained, if you look at pensions, there's a lot of data. And the key question I was given, can you give a little bit of background regarding the track record of occupational pensions, the recent developments, and the impact of COVID? And of course, links to the key question, as was just in the introduction, what are now the key performance indicators? If you look at dashboards, when are things going well? Should I look at the return? Should I look at the funding ratio? Should I look at the adequacy of pensions? So a wide range of possibilities. So first, I will go in that topic in a little bit more detail. Second, of course, it's easy to identify periods of crisis and see how do we score and how do we survive those periods. Thirdly, is there not so much the current crisis, but a more longer term? What's the impact of climate change or a wider range of environmental and social and governance? And in that way, I would say we can discuss also somewhat longer term trends. And finally, most importantly, it's to see what is now really contributing to a good or a bad performance. So what are the drivers of the performance? And with this introduction, I will give it back to the other speakers to go in more depth and detail. And if you look at performance, you would like to look at global performance. That's quite difficult because, as was introduced, many countries have different setups. So what I will do first, I will go through three typical regions in terms of defined benefit pension plans. And I start with the United Kingdom. And this is immediately quite a complicated graph. Because it starts not at the COVID, but it starts almost a decade ago. And on the right-hand scale, you see a funding ratio, the ratio between the assets and liabilities of the UK pension plans. And if you talk about liabilities, you can have all kinds of definitions. Please see this as something that's related to market value. And you can see the developments over time, starting around the 80% in 2012 and seeing a current level that's above 100. So in that way, you can see the performance has been good and the development have been strong. Should funding ratio be your main reference of the performance? And in a way, you could actually say, well, it's above 100, so goal is achieved. And that might be a trigger for change in the different strategies that will follow. Finally, if you look at the COVID period, it starts Q1 2020, and you can clearly see that the last 4 quarters have been positively contributing to the development of the funding ratio. So all in all, if I look at UK, quite okay. Second step that we can take is if we now look at US, and US is quite difficult because you have seen there a lot of different types of valuations. You have seen a lot of different closures of defined benefit plans and starting of defined contribution plans. And the best approximation I thought would be possible is following this Milliman index. And just by explaining what you see, this is an index that is showing you the value of the assets of US public companies on a global scale. So if you take a General Electric, it's a public listed US company, has a lot of pension liabilities and assets across the globe. That's all added and it's presented in this number. So it's not just US ERISA type of plans. No, it's a global the global plans of a US company. Here it starts even earlier. It starts in the early 2000s, and here you see a lot of red indicating that there is a deficit, so there are less assets than liabilities. And also here you can see that's quite stable, but below the zero in the past decade. If you look at the most recent periods, that's a little bit in the small circle, there you can clearly see that the recent quarters and the period of COVID contributed to an increase of the position, and in that way, otherwise stated, a less negative position, now close to zero. And it has not been seen since the period just before a financial crisis in 2006 and 07. So also here, COVID in a way was helpful to translate to a better initial funding position. Finally, and this is, I'm from the Netherlands, and if you can see, we make things quite complicated in the Netherlands. This is the graph similar to the previous two graphs, but you see a lot of colors because we have a lot of definitions, and in a way we choose the definitions that fits most. And you could say, well, then probably you take the most positive one. Well, typically, if you talk about pension in the Netherlands, we took the most negative one, because I haven't seen many countries that are so strong in defining their liabilities, nominal market rate liabilities, and you best follow the yellow line, which is in a way the smooth development of the funding ratio. And also here you can see that the period just after the introduction of COVID to the world showed an upward swing in terms of funding ratio, and also here resulting in an above 100% funding ratio. So all in all, if I summarize, if I take a dashboard and I take a funding ratio and I look at the recent performance, the performance has been relatively positive. And in most cases, we see now that we are closer to a fully funded or at least a good starting position. Be aware, that's a general conclusion, and it's averaging over countries, averaging different systems. And I think that's what the rest of this presentation should help you to see how we can make this more separate for individual cases. So first, the main observations, funded ratio improved. Second, large differences in asset allocation. So you cannot just say, well, the US plan did better because they did a better choose a better allocation. Also, the risk taken to arrive at those conclusions is quite differently. Final remark. If you look at the funding ratio, of course, it's not just asset and asset returns. Also contributions play a role, and those have been high and increasing. And we have seen different levels of inflation compensations in some countries like the UK, fully compensated, in a country like the Netherlands, not compensated at all. So please be aware, you cannot compare on a like-to-like basis. So therefore, it's, I think, more important to look at your individual plan and see what is the driver of that performance. And it's easy, you can say, well, that of course is dependent on the financial market performance. And in most countries also, there's a link to the interest rates. So just look at the market performance. However, past performance is also difficult because it's just one single realization, and how much risk was taken to arrive at the most recent observation. Well, If you look at risk, then it's of course also important, how do I allocate over time? Is it static? Is it dynamic? Is it driven by return? Is it driven by risk? If you look at the current funding ratio, do I now take off risk of the balance sheet because I'm better funded? Well, this depends on regulatory environment. Some regulators say, well, you have a deficit, please keep contributing to your plan, as is the case in the Netherlands. While in the US, you are punished in a way, if you are above 100, you start paying taxes on the assets in your pension accounts. So regulatory environment plays a role. And also very clearly, the governance and board composition plays a role. And I will come back to that in a minute, as I come back to the ESG policies and environment as well. First of all, the drivers of the investments, not just financial markets, also the liquid and more importantly, the illiquid part of the portfolio plays a role. And I'm sure Eduard van Gelderen will discuss this in more detail. Second, a pension plan typically is a longer term investor. Can I have an endowment-like strategy, yes or no? Or am I forced to a more shorter term development in terms of regulatory pressure to get also short-term compliance with risk limits? And a nice recent PhD a few months ago, Mr. Bonetti had a PhD, but showed all kinds of alternative factors, like what's the average age of the board trustees. And he showed, well, if the board of trustees is older, they invest less in equity. That's because their mindset is life cycle driven, and that's easy to explain. At the same time, a corporate plan with strong representatives of the sponsor allocates more to equity because they have, in a way, in that way, lower the contributions. If you have the common advisor effect, that's also a risk in itself. If I, as a person, advise 10 pension plans, probably I still have the tendency to have a similar view on those 10 different cases. And finally, if I see this herding effect, in herding effect, I mean that plans look at each other. One of the most common questions to an advisor is, how do other pension plans allocate? Then you see that the herding effect, in a way, delivers underperformance, and not just by a few basis points, no, more than a 1% point on an annual basis. So in that way, please also keep in mind alternative factors driving your performance. Well, a factor that plays a role in the common discussions and the current discussions is really when it relates to the ESG policy. And ESG will play, how this is play a role in the decisions the board takes. All kinds of research. And first of all, it's clear that there is no best practice yet. Because traditionally within Europe, the Northern European countries have seen as the countries that started this trend first, so especially Sweden, later followed by Norway, Denmark were the early movers. And you see large differences, and by large I really mean very large. For example, in Denmark, almost all pension funds completely divested from carbon-intense firms or sectors. And the only common denominator we see is that they have stopped investing in the more controversial sectors. So large differentiators or large differences showing that it's early stages. Second important study is of this year, showing that there is limited evidence that if you invest in stocks with a better ESG scores, that you actually get a higher performance. So there is no
2 more minutes, Martin.
Yes,
yeah?
yes, please. So there is no direct link to have a better ESG score and then see a higher return. And this is unfortunately also quite robust, with one exception. In the Northern American market and maybe also the Canadian market, you see that in a higher or better positioned stocks in terms of ESG scores do better in periods of risk. Well, finally, decision making, you can have all the information and you can all the dashboards. In the end, it's decision making. And please be aware that we all ask ourselves questions like, what do others do? Is it better to give full transparency? or does it result in lower trust? All kinds of behavioral biases. I made a decision last year, can I change it? Well, there is maybe a relation between the number of board members and the allocation, or is it not there? And in this way, decision making based on data is an art and a science in itself. And bringing this all together, I would like to conclude and say, well, please analyze past performance, because there are always lessons learned. If you do so, it's really a job, because it's not so easy to identify the major drivers of this performance. If you look at the performance, please also see what beliefs, and with beliefs I mean things that you cannot say for certain, and decisions contributed to this. And in the end, if you have formal and objective numbers, please do not underestimate the impact of the behavior of the trustees on the final decisions. And with this, I hope to have given you an overview of the recent performance and some of the drivers of this performance. And with this, I'm happy to hand back to the chair.
Martin, thank you very much. Very interesting presentation. Food for thought, the pitfalls of performance measurement and understanding of what's going on for pension funds. So thank you very much. Our next presenter comes from Canada, a country that is very well known for its innovative and sophisticated management of public pension funds. Edward Van Gelderen is Senior Vice President and Chief Investment Officer of Public Sector Pensions Investment. Edward oversees PSP investments, total portfolio, and establishes the long-term investment portfolio strategy. He also heads the responsible investment, public policy, and government relations functions. We are all looking forward to his views on how do successful occupational pensions manage contributions. So, Edward, please.
Thank you very much. And let me also try to share my screen. Here we go. And right, here we go. So good day, everybody, and thank you, Professor Skiadopoulos and IFFR for having me. I really cherish this opportunity to speak more about the Canadian model, but more specifically about the public sector plan in Canada. And let me first of all make a very clear statement. When we speak about the public sector pension plans, this is a public pension plan. So if you look at Canada as a whole and the pension system in Canada, clearly there are multiple individual schemes, pension schemes. There are also corporate pension schemes, but they're in a very different state than the public pensions. So when people speak about the Canadian model, what we refer to is the public pension market, the public pension plans, and not so much the other types of pension plans available in Canada. So PSP Investments is a relatively young organization. It started only 20 years ago as part of the basically the public pension reforms that we saw in Canada. It really started with Ontario Teachers Pension Plan, where basically the general feeling was that they had to increase the status and the functioning of that plan because of a variety of reasons. There was unclarity about the governance. People were not that impressed with the performance at all. It wasn't quite clear, like, where are the benefits going to, what is the basis for the contributions, etc. So basically all the fundamental questions that come when you run a pension plan. So in the 90s, basically you saw a lot of the public pension plans in Canada coming up with reforms, and PSP was actually established as a new manager for public pensions plan, more specifically related to the pension plans within the Canadian government. So the public service, Canadian forces, the police, the reserve force, these are all federal funds that are managed, or at least the assets are managed by PSP. Now, clearly, there are a lot of other public pension plans, but they're managed, governed by the provinces. So we only do the ones that are governed by the federal government of Canada. Another important thing to point out is we only take care of the post-2000 liabilities. All the liabilities pre-2000 are still based on a pay-as-you-go system. So we are a young organization, but also the pool that we manage, or at least the liabilities related to that pool, are relatively young. So again, I will come back on this. What you'll see is that the liabilities are really long-term. Now, if you look what happened over the last 20 years, you see a very significant growth. And this is partly the result of two factors. One is the contribution, and the other one is the investment return. And remember, when we started in 2000, there was actually hardly any money to invest. All the money that came into the funds was actually based on contributions. And timing-wise, that was quite interesting because it was the internet bubble. So when PSP started, basically markets were trending down, and at the same time, more money was coming in from the government. So in a way, you could argue we had a very good start in 2000 because all the money that came to us was actually invested at lower levels in the equity markets and surely benefited in the years after the crisis. Now, the cash flow is still significant. Currently, this year, it's above 3 billion. But if you compare that to the current size, 220 billion, clearly it's less significant. And going forward, this will actually go down to zero in the next 7-8 years. And that means that the fund is going to be totally reliant on the investment results going forward. Now, over that period of time, over the last 20 years, and Martijn already alerted to this, we've seen significant changes. We've seen changes in the asset mix. From the very beginning, it was only listed equity and bonds. And then we started to add private asset classes to the mix. And we started to move away from passive management to active management. So during this development, real estate was introduced, natural resources, infrastructure, private equity, all along the way. And we also started to become a more global organization, not just an investment hub in Montreal, but actually very significant offices in New York, London, and Hong Kong. And going forward, I'm sure we're going to open another office somewhere. I mentioned the Canadian model a couple of times. I like to, I'm not going to go into this, but I like to say that Sébastien Berthamier, who is a professor at the McGill University here in Montreal, will speak about this model tomorrow in much more detail than I'm going to do now. An interesting and important thing also to realize is the legislative framework. So when we think about the federal pension plans, they all have their own specific act. And in the act, it's really described what the sponsor or what the government is supposed to do, what kind of benefits are needed, what the tax status is, and more importantly, the funding requirements. But what is very significant as well is there is no solvency requirement here. And that is really because the principle is that those pension plans are there and will stay there for the foreseeable future. So in contrast to the situation in the Netherlands, where a very conservative approach is taken, like you should always be solvent when you stop the fund or close the fund at any time. Here the thinking is much more like, no, those plans are certainly not going to disappear. We're not going to close those plans. These plans are here to stay for the future. And that really makes, I think, a very big difference. Then if you go to the other side of this graph, there's the PSP IB Act. And that basically tells that PSP investments is the sole investor of the assets related to these federal pension plans. So what it means is that we have a very strong relationship with our sponsor. And actually over the years, I think it only became a stronger relationship for the reasons that I'm gonna describe right now. And that's the relevance of the plans. And Martijn already alerted to this. So if you look at the left side of this graph, you see an indicator. And to be honest, it's nothing more than that. It is an indicator saying like, what are the assets under management of PSP versus the federal debt? And as you can see, 2011 as the starting point, it was like 10%. But if we then move all the way up to basically when COVID started, it moved up very quickly to 25%. That's a significant increase. And the reason why it dropped actually from 25 to a lower number to as it is today is not because our assets declined, but it is because the federal deficit actually ballooned. Like any other government, there has been a lot of fiscal stimulus. And as a result, federal debt has increased quite significantly. That is the main reason for the drop in the number. But we expect as soon that is going to be normalized, the assets in the plans are continue to rise, and therefore the relevant or the number will probably move back to the 25% again. And that's important because when we speak to our sponsor, the government, they basically said a few years ago, like, well, when we go back in time, when the fund was only 50 billion, which is also a significant amount, but when it was 50 billion, a deficit, and you have to be mindful that the government, the sponsor, is fully responsible for filling the gap of a deficit. So when they said when the fund was 50 billion, a 5% deficit was, not nice to have, but it was very doable to put that in the federal budget. But now with the funds already 220 billion and expected to grow to 275, 280 in the next 7, 8 years, a 5% deficit becomes a fiscal burden. So they have been very clear to us, like, how can we manage this? The plan has done exactly what it was supposed to do since the start, 2000, covering basically the liabilities, but it was like a ramp-up period. And now looking forward, they say like, okay, and now we still have to manage it very carefully because we don't want to run into any significant deficits. It needs to cover the liabilities. And when you translate that into the funded status, you basically you see the following chart, which is not that different than what Martijn actually showed in the previous presentation. So the funded status currently is around 120%. But you also see the major impact of the global financial crisis in 2008, 9, and 10. A significant drop in the funding status. Now that situation means that the government has to step in, and they don't have to fill that gap in one go, but they are responsible for filling the gap. But they can amortize basically the amount that they need to put into the funds. So when the funds are actually moving back to a fully funded status, the obligation to put more money in stops. So that is in the benefit of the government. It doesn't mean that, the experience tells us that it doesn't mean that any deficit will be 100% on the plate of the government. Because of this amortization element, part of it is actually pushed out into the future and might actually disappear dependent on the development of the funded status. Now, again, I would also like to emphasize here that when the global financial crisis hit, the size of the funds, PSP funds, were around 40 billion. So very significantly smaller than what we currently are. And again, I would emphasize if a similar situation would occur nowadays, that would be a very, like the government says, that would actually trigger a fiscal burden. So what does this all mean? It actually means that we have to manage the portfolio accordingly. This is the mindset. This is basically the thinking behind the plans, and the asset approach that we adopt is actually with this mindset or as the guiding principle for what we do. And what the government is doing is the following. Let me just quickly go back one slide, because here on the right at the top,
Edward, you have 2 more minutes. Sorry.
Oh gosh, I was afraid of this. What you see at the top is the risk tolerance statements. And basically it says, like, you know, we need to have a 95 probability over a 10-year period that the funded status is above 70%. Now, to translate that in a actual portfolio, they provide us with a so-called reference portfolio. A very simple portfolio matching that risk tolerance. It's very simple because it's only listed equity and bonds, it's passive and nothing else. But then when you go to the policy portfolio, and that's something we're responsible for, we've got actually a lot of degrees of freedom to introduce any investment strategy we like. So as you can see on the right, we have a very, very diverse portfolio consisting of different regions, public markets, private markets, etc., but also a lot of illiquidity in there. Now, in the interest of time, let me quickly, well, not skip, but make one comment. When we think about portfolio optimization, we do not focus on mean variance optimization, because variance or market volatility is not the right risk measure to deal with. In our case, it's funding risk, and not just the mean, like over or under funded, but also the tail risk. So the optimization we do is in terms of scenario analysis. We also do a lot of factor assessments. We are interested in all kinds of investment asset classes that help us in minimizing this funding risk. And clearly, given the funding risk, we try to optimize the returns as well. So we rank those asset classes accordingly. And again, these finishes or these scores are not based on benchmarks. They are based on what we actually do within the asset classes. Just to sum up quickly and to stay within the time allocated to me, as Martijn actually mentioned in his presentation, there are a lot of things that are very similar, things that we do. So we really use a very long-term focus. The short-term volatility is not of that importance to us. And it does mean that we can accept a lot of illiquidity, but we can also be very entrepreneurial in our investment strategies. So that's what the platforms mean. We can also look into alternative investments. We don't have to stick to the traditional asset classes, listed asset classes. Like Martijn said as well, it's more an endowment type of mandate. It's not a relative return mandate. We really work on an absolute return. You know, we can create more value for the plan as long as we have a higher return than the discount rate used. And we do it by moving away from traditional asset classes to more factor-driven approach. Now, the number of investment restrictions in our mandate, I would argue, is very limited. We are actually in a very fortunate position that basically the guiding principle or the guiding limits that we have is the risk budget. But for the rest, there's a lot of degrees of freedom to do anything we think is in the best interest of our members. And that's unique because it actually moves you or sets you aside from what, let's say, traditional commercial asset managers can do. We can actually play in a field where others cannot enter. And that is partly where the returns are coming from. I already spoke about the risk measure, but the last point I want to address, and again, it was mentioned in Martijn's presentation, the governance is extremely important. We've got a very interesting line of stakeholders in the sponsor, our board, and the investment management organization. They all serve the same purpose. They all say, but they do have different responsibilities. But our interaction with the sponsor, but also with our board is, I would say, is unique because it's a very intense relationship and a very supportive relationship. And that certainly helps also for us to stick to our long-term strategies, even when markets are going against us, like last year in the COVID crisis. The interesting thing was when COVID hit in March last year, the board actually stood side by side with the management of the investment company saying like, yes, we should stick to our approach. We believe in it. Where can we help you? And at the same time, I had regular calls with our sponsor to discuss what was happening, but there was never a moment of panic. And I think that type of governance where there's full transparency and alignment of interest is extremely important for our success. And on that note, I like to hand back to the chair.
Edward, well, thank you very much. Again, a very interesting presentation. Thank you for sharing your thoughts on the management of a public pension fund. And this is especially important for us Greeks because we have just established a public defined contribution pension fund. And obviously we would like to have as much of your experience as we can. Okay, our next presenter is Justin Ray from the European Insurance and Occupational Pensions Authority, an organization with a major role in the supervision, consumer protection, and regulation of occupational pension funds and insurance across Europe. Justin is head of the policy department and head of the insurance policy unit. He has been responsible for the provision of advice on the institutions for occupational retirement provision. He's also behind IOPA's technical standards and guidelines, which are required under the Solvency II Directive. He has worked in the past for the UK pensions regulator in a number of operational and policy roles, including as head of pensions administration and governance. I think you will agree with me, he's the best person to talk to us about IOPA's recent initiatives. So, Justin, we are ready for you.
Thank you very much, Professor Tessalromatis, and good morning, good afternoon, or good evening to everybody. Thank you for the invitation. It is a pleasure to be able to speak to you. Let me try and do as the others and share my slides. I hope you can now see my slides. No, not yet. Okay, I hope you can now see them in the best way. Sorry, I'm trying to start my video, but I think this is controlled from the center, so I can't appear in front of you. If it's possible to change that, that would be great. Very good. Well, look, let me start. And as was already mentioned, I represent the European Supervisory Authority for Occupational Pensions, EIOPA. I am going to talk briefly in my 15 minutes about some recent EIOPA initiatives on costs and charges, on defined contribution risk assessment, on advice that we've given to the Commission that was already referred to by Didier Miguel. I'm looking forward to the review of Iop 2 and just a couple of observations on Greek occupational pensions as I was asked to provide. Let me turn then to the initiative on costs and charges. I mean, I don't need to tell this audience and the experts here how much costs and charges matter. And this matters, of course, especially in a world which is becoming increasingly defined contribution. I mean, this is certainly the trend within the European Union, and it is, I believe, the trend kind of more or less worldwide. So this is costs and charges not only matter, but are mattering more. Moreover, what was clear was that within the EU, most supervisors simply didn't know that, as it says here, only 5 out of 25 supervisors actually collected transparent cost data, and that to the extent we have evidence, transparent cost reporting works. And the prime example here, and I'm sure Martin may be able to comment on this, is in the Netherlands, where once costs from pension funds were reported in a transparent way, they decreased dramatically in some cases. In terms of the supervisory expectations set by EIOPA, firstly, we expect our member supervisors to start collecting cost information, and this be broken down in what is fairly standard components. As a means of providing practical help, we provided templates for assisting the collection of these costs, that the collection of costs should follow a set of, again, fairly standard principles, avoiding netting, subject to look through, in particular to capture indirect costs imposed by investment managers and funds, so that the full cost picture is revealed. And of course, this is, I mean, we're a supervisory authority, our members are national supervisors, we expect supervisors to act on the results. And therefore the analysis that they carry out of the costs of pension funds, or IOPs as they're called in Eurospeak, that should feed into the supervision of pension funds. Let me turn to a second opinion that EIOPA published in the last couple of months on the risk management of defined contribution schemes. Again, I mean, it goes without saying that this is an increasing trend, that this opinion focused on two aspects in particular: operational risk management. Again, if in a defined contribution environment, if operational risk crystallizes, this is much more likely to impact on defined contribution members in terms of affecting the size of their pension pots and future projections. So in one sense, it has a more immediate impact. Likewise, in terms of projections, I mean, it matters that pension funds think about risk from the perspective of members and beneficiaries, and that they therefore make projections which reflect the risk tolerance of their members, and that they keep the investment strategies under review. And I mean, it was interesting to hear from Martin and Edouard about the risks, the investment strategies in the funds for which they are responsible. All right, that was a little bit about some supervisory expectations. Let me turn now to what Didier mentioned in his intervention on the advice that he asked, that EIOPA was asked to provide in the context of the Capital Markets Union on pensions dashboards and pensions tracking systems. Let me start by showing this slide on the importance of tracking systems and dashboards. Again, I hope you're seeing it. The left-hand chart shows the move towards defined contribution arrangements in 23 member states. I mean, what is striking here is that this covers only 3 years, and yet there is a material increase in the number of active members who are in defined contribution schemes. I mean, you all know how slowly the world of pensions can sometimes move. This is quite a dramatic change, but Europe is going quite quickly into a much more dominant DC environment. In that environment, it is much more important that there are good tracking systems, that if the risk of an adequate pension is put onto the individual, it matters more that they have an understanding of what are their pension entitlements. And we know as well from how individuals tend in practice to behave, that they don't necessarily favor activities such as finding out about their pensions. So again, a tracking system which is easy to use, which is easily accessible, is more important. Didier mentioned sort of demographic challenges, and the chart on the right is an illustration that's familiar actually to nearly every region of the world now. Why do I put that up? Because it shows the importance of the pensions dashboard, which I'm coming on to. But in a world where demographics are working against you, it is more important than ever to know whether a pension system is adequate and sustainable, and that is what the pensions dashboard, which the Commission asked EIOPA to provide advice on, is seeking to do. Let me just go into a little bit more detail. Firstly, let's start on the pensions tracking systems. Here are the 4 components of EIOPA's advice. The scope, I think, is quite interesting. I mean, we advised that in thinking about the establishment of a pensions tracking system, one should have in mind the average EU citizen. And when I say average EU citizen, I therefore don't mean the kind of hypermobile cross-border EU citizen, which are which certainly exist, but actually within the EU, most people live and work in one country, and that a tracking system should cater for their needs more than those who say live in one country, work in another country, have worked in several different places. That it should focus on the average rather than the exception. Designing a pension tracking system for users, one of the findings from those who have already built pension tracking systems is that 75% of users do not leave the landing page. So whatever it is whatever information you want to convey, you want to have it on the landing page, because relatively few dig deeper. And therefore, in terms of sort of what is the most important information, if you're looking at a tracking system, we believe it is going to be what will be my pension. And moreover, that pension should be expressed in a form that is easily understandable, and that, at least in the EU, is on a net monthly basis. And therefore, that although there is much other important information that one can provide, such as the size of an accrued pension pot, if you're aware that you've kind of got a one-shot deal, that they'll only look at one page, it is how much pension am I going to get per month. In terms of the back end, things like the protocols for passing data between the tracking service and the relevant pension schemes, the need for standardization, these are all important. And in terms of the governance, I mean, our advice is that a pensions tracking service is essentially a public good, that it should be run on a not-for-profit basis. There should not be a conflict of interest between wanting to provide individuals with their pension entitlements and, for example, wanting to sell to them. That it should be viewed as much as a public entity, or perhaps a public-private entity, but not a commercial entity. Moreover, it should have the objective of providing information about the individual's pension entitlements. It shouldn't say seek to then to provide financial advice. So its scope, its governance should be clear in those respects. Let me turn to the second piece of advice on dashboards. I mean, this just tells us what are the benefits of dashboards, and there's 2 examples from the COVID pandemic and something issued by the European Central Bank on the fiscal dashboard. And the challenge for EIOPA was, is it possible to do something similar in relation to the adequacy and sustainability of pensions? And the answer is yes, but it's difficult. And if I turn to EIOPA's advice on pensions dashboards, what you will see is that we explained that there is a gap in terms of the current monitoring of adequacy and sustainability throughout the EU, and that in particular, we were asked to look at the completeness and reliability of data, which we went on to do. This
Justin,
is perhaps
Justin, you have 2 more minutes left.
Very good. This is, in which case, let me keep going. I think that's probably the best thing to do. This just sets out where some of the data gaps are, and in particular, firstly, not in relation to public pensions or Pillar 1 pensions in the jargon, and this is outside EIOPA's scope of responsibilities anyway, and on the whole, not within occupational pensions, though things like breakdown by age and gender are missing there as well. And these things are important if a pension scheme which only favors one gender, or where one age cohort has all the assets, is not necessarily an adequate or sustainable pension arrangement. So these factors are important. Pensions provided not in the occupational space is where most of the data is missing. So I've got about a minute for 2 other topics. The review of Iop 2, again referred to by Didier. I've shown you this slide as well, so I won't dwell on it, but just to say the shift to DC and the demographic pressures are, of course, important context also for the review of the legislative framework for European pensions. Let us remember that a European approach to pensions has benefits, and some of them, again, were mentioned by Didier and are worth mentioning here as well. The internal market in terms of things like labour mobility and capital markets union. The protection of members, there has to be some consistency in standards if members are to be members of occupational pension schemes in other countries. The benefits of transparency, and finally, Europe as a force for improvement. I mean, every national pensions are very diverse throughout the EU, but everywhere is capable of improvement, and the EU can act as one of the forces for improvement. And member protection, just a little bit more on that. Both explaining again, emphasizing the shift to defined contribution and why that makes member protection more important, and moreover, why you're starting to look at other things. So you're starting to look at governance, investment, administration as much as funding. Cross-border IOPS. This is where we have to acknowledge that the current European framework hasn't succeeded, that actually the number of cross-border IOPS has reduced, principally as a result of Brexit. But this is not a framework which one can say has been effective until now. So again, something to look at in the advice. So very quickly, let me just make 2 observations on the Greek occupational pensions. Firstly, demographics. These were in favor of Greece several decades ago. Now they are against it. That compared to the EU 27, Greece is aging more rapidly, and you can particularly see this in the next 30 years, so between 2020 and 2050. So in terms of thinking about Greek pension systems, clearly there is a demographic challenge. Moreover, as this slide shows, at the moment, Greece is not choosing to go down the occupational route to any large extent so far, though of course it was interesting to hear already about the establishment of the public defined contribution pension fund. Occupational pensions are not the only way to fund retirement, but they are a way, and typically diversity of sources of pension tends to be optimal. So again, that is something to think about. That's it. I hope I haven't run too much over time. Thank you everyone for your attention. Professor, back to you.
Thank you very much, Justin. Very interesting to hear about the initiatives of IOPA. Okay, well, thank you very much on the 3 presenters. There are a number of questions, so let me start with one for Martin. Martin, This is my question, really, is on what you said on ESG. I mean, we know this is a very big thing. I think it will continue to be so in the future. So here's the question. It looks like ESG is no longer an optional extra for trustees, managers, pension providers. There are now legal requirements that they have to take into account ESG. The evidence, which you reviewed as well, seems to suggest, academic evidence, that companies with high ESG will have lower returns in the future. Okay, so in your experience, you talk to a lot of trustees, a lot of managers there. What are pension trustees' expectations with regard to this ESG and returns? How do they align the ESG goals if they understand that the returns will be lower with the fiduciary duty of protecting the retirement funds for their members?
I think a very relevant question. In a way, trustees started to add risk to the return. So historically speaking, first they had a return goal. Next, this was how much risk do I need to take to achieve that return? And I would say in the last 5 years, a third element was added. How do I score on ESG? I can have a nice, adequate pension, but if the world is not worth living in it, I should, as a trustee, take that into account as well. And exactly as you explained, in some jurisdictions, the focus is still fully on return, or potentially the return and risk, in a way that it's almost impossible, for example, for US trustees to act basically on ESG if it's not clear that it's also supportive of return and risk. And I think that's also part of the answer I see globally. If you look at return only, it's hard to say, well, it adds to return. If you look at return and risk, it's typically already slightly easy to show that the combination ESG scoring or high ESG scoring companies are really delivering better on a risk-adjusted basis. And if you look one level deeper, if you look at the major drivers of risk coming from climate change, it's both the transition and the physical risk. Physical risk is too much in the future to really account for now. However, transition risk is very relevant already now. And I think it also requires a different mindset, because sometimes you think of this is the minimum risk. If you look at this from a climate perspective, COP26 already confirmed again, 1.5 degree global warming is the minimum. Is this now also a good floor in your strategy? Well, probably not, because if you see the 1.5 as a minimum, then you really have to act now. So there's a lot of transition risk and a lower physical risk in the future. If you do the other way around, probably you see less transition risk and more physical risk. And that introduces a third element, and that's the timing difference with the ESG integration. And I think on the risk and return, I see that there is already quite some progress to integrate ESG in this as well. But this horizon issue is still a very difficult one to cope with.
Well, Martin, thank you. I mean, this is obviously an issue that will be with us for many, many years to come. But so thank you for your answer. There are a number of questions which I will try to combine. That are for, I will alternate, so I'll come back to you, Martin, for Edward. So a question there is the role of different assets, or is it factors that you see for mitigating funding risk? There is a question, for example, here as another related question, you manage a portfolio of assets nearly as large as the GDP of Greece. Oh, wow. And that has delivered extraordinarily strong returns. You say that this portfolio allocates 1/2 of assets in private markets. Please expand on the thinking that led you to such a radical departure from typical European pension fund portfolios, in particular the Netherlands, I'll say, in many other countries as well. What's behind this 50% non-traditional assets?
Yeah, it's a nice question to answer, and I'll try to answer it also in the context of the development I described. So first of all, the approach that PSP has taken and many other Canadian public pension plans have taken is that we are in a position that we actually can accept certain risks that will lead to better returns. And I think one of the drivers of the Canadian model for sure is that part of that is illiquidity. So being able to invest in less liquid assets, whether it's in infrastructure or real estate or doesn't matter where, that actually that illiquidity still, at least when we started to build it up, that illiquidity led to a higher performance. So to put it bluntly, if you do not believe that private equity will pay you a premium over public equity, then you shouldn't do it. But the conviction that the Canadian model had and PSP2 is that actually in a lot of those private markets, there is a premium that you can actually benefit from by investing, knowing that you will be stuck to those investments for a longer period of times. So the tradability of those positions is less clearly than when you are in the public markets. But the situation, for example, for PSP is there is no need really for liquidity for the years to come. So there is a liquidity need if you have to pay out cash because you're an older pension plan. Well, that's not the case with the federal pension plans, because in the next 7-8 years, there's still more cash coming in terms of contributions than payments that we have to do for the pension payouts. So there's no liquidity need from that aspect. The liquidity need that we have is coming from two things. It's the use of derivatives and the margin calls, and it's the commitments that we do in the private asset space. So when we talk about liquidity, we're looking at those type of commitments and margin calls that is driving our liquidity needs. But it's not that we have to be liquid because we see that we need to pay out more on the pension side. And clearly, in contrast to any commercial asset manager, we don't have the in and out flows of cash. We know actually pretty well what type of cash is coming in terms of contributions, and we know what we need to pay out in the years to come. We know our commitments in private assets, and we do know what the margin requirements are related to the derivatives. So we are very much in control of our liquidity needs. And that provides us more than enough space to invest in the private assets for the years to come. Now, going forward, because that's an interesting part of your question, going forward, it is a bit of a question mark, like, will it remain at 50-50? So clearly it worked out in the past, but one of the questions for the Canadian model is, will this also work going forward? Because we know that more and more, especially institutional investors, are moving into private asset classes, and we see the risk premiums in those private asset markets also shrinking and getting really close to the risk premiums we see in the liquid markets. So the question here is like, is it still rewarding enough to go into private assets? At this point in time, we think yes, and that has to do with the mandate that we have. Like I said, we've got an enormous degree of freedom in terms of where we look for the different investment opportunities. And we still believe that there are many opportunities for us to invest in private assets, generating better returns than we could get in the public markets. Now, another development, because part of the question was also on factor, are we really going to stick to the traditional asset class mix? I don't think so. Going forward, I think what becomes very important is the risk premiums that you can get in the market. And especially in a low yielding environment, having access to the best rewarding risk premium is actually what we're looking for. But you can only do that when you are basically asset class agnostic. you really have to look like, where are the risk premiums, and I will allocate to those premiums. And what I mean by that is that basically the traditional way of dividing the big pie into different asset classes, we're moving closer and closer to dividing the big pie into risk premiums. And then we have to know, like, okay, but where is this risk premium? Well, for example, inflation. What is the best reward you get for your inflation risk? Is that in IOBs, or is that in infrastructure, or is it in natural resources? That is the type of questions we're moving into very quickly. And once we know where the best reward is for that risk that we take, so what is the best risk premium for that risk, we will allocate to that specific factor. And that could be enlisted, but it could very well be in private assets too. Now, this is a journey that just started, but I'm convinced that that is the way we're moving. We're moving to very rapidly, but it needs to be. It's only possible in the current setup as we have, without very strict restrictions on what you need to have in certain asset classes, what is not allowed to do. We've got a lot of freedom to make those choices. And that degree of freedom actually allows us to generate the better returns.
All right. Well, good. Thank you. If I could have your brief comment on something that you said about your relationship with the Canadian government, the sponsor, right? And then what sponsor? And this is a very powerful sponsor here. Now, this is not the experience of many other countries, and I'm not talking only to countries in Latin America, but where some European countries as well. How do you do it? I mean, if you could give, I mean, I know it's a big topic, but give us a short comment. How do you manage? And you're not the only one. There are other Canadian public pension funds, and they seem to be doing very well. How do you manage this relationship? And, you know, you do it in such a way that it doesn't create trouble for your investments.
Yeah, I think you have to go back really to the pension plan reforms. So what I mentioned was, you know, when you go back to the 90s and when Ontario Teachers started to reform its plan, and by the way, that's a provincial plan. You know, one of the concerns was really the governance structure around it. It was actually very ambiguous, very vague, like who is responsible for what, who's accountable. And I think the Canadian model did a very good job in saying, like, well, you know, the governance really needs to be working in the best benefit of the members. The members should not suffer from poor governance. And that basically means, like, all the different stakeholders, they play their own specific role, but in the end of the day is the one and the same objective. Everything we do should be in the benefit of the members. And I think most of the Canadian plans took that at heart. And I cannot speak for the other plans, but certainly, you know, we really established, I think, a very good relationship with our sponsors, or with the Canadian government, in a formal way, but also in an informal way. We are very transparent. We have a lot of discussions. The government actually launched a asset liability committee with, you know, the government involved, representatives of the pension plan involved, we as a investment manager involved, but also the chief actuary. And we all sit around the table discussing the different topics. And we do that very regularly. And I think just by doing that, it really creates a sense of, well, we have a joint objective here. And we just, you know, we should pick the best solution we can find, again, in the interest of the members. You know, I would almost say it's as simple as that. It's not that simple, but it's definitely, I think, what we have in place right now. And again, it gives me a very comfortable feeling that if I am in doubt about something that we do in terms of our strategy, yeah, I feel totally free to pick up the phone to our sponsor and have a discussion on it. And at the same time, the sponsor is very clear, like, yes, we like to have that discussion, but in the end of the day, you are at arm's length. So you're responsible for the investment decisions. And And I think that realization related to all the different stakeholders, having that in place is very powerful.
Okay, all right. Well, thank you very much, Edward, for this. And well, I've got a number of questions for Justin. We don't have the time, but let me try and ask some of them. Yeah, according to the setup of the Greek, what is this? Okay, Greek public pension fund, the new Greek pension fund, TECA. In case TECA invests in bonds, there will be no count to the Greek debt. This may distort the criteria for asset management. I don't know, Justin, I mean, would you like to comment? I mean, it doesn't seem to me to be one particularly directed to IOPA, but would you like to?
And to be honest with you, no. I mean,
okay, good. All
that
right.
is a matter
Sorry,
for
okay.
I don't know enough about the particular fund and what it.
Of course.
What
why?
To give
okay, sorry,
Justin.
Yes, sure. Why is it that there is nearly no pension benefits are portable between countries in the EU? What is IOPA's view on that? There is nearly no pension benefits which are portable between countries. Is that?
I think that I hoped to make it clear in my presentation that the internal market for occupational pensions has not been a success. That you know, although the relevant directive creates the possibility for an internal market, for a sponsor of a pension fund to be in one country and its members to be in another, or for there to be a transfer of a pension scheme from one country to another. These are used relatively rarely and the numbers are low. Now, in terms of the reasons for this, I think that partly it is the diversity of pension arrangements within the different countries. So it is it's not a homogeneous product which you can take from one place to another very easily. I think it also relates to the fact that the relevant directives are minimum harmonization. So, for example, although the directive says a pension scheme has to be fully funded at all times, that means different things in different countries. I mean, IOPA has done very convincing work showing that this is such a where funding requirements are subject to national interpretation, they differ hugely. And so, again, in terms of members in one country trusting the funding status of a pension fund in another country, there is still the legislative framework is not overly conducive. To this. So and the final thing is that the directives extend only to prudential law. They don't extend to social and labour law. That is for the member states. That's one thing. Also, there is no common definition of what is the boundary between prudential and what is social and labour law. So what might be prudential in one country is social and labour law in another. So it's not the most straightforward picture. For all those reasons, I have to agree with whoever asked the question. Pensions are nearly not portable within the EU. The framework doesn't really work.
All right, well, Justin, thank you very much for this. And there are many more questions here, but I am very cautious of the time as well. So thank you, those of you who asked those questions, but we don't have time. Justin, we're looking forward to the pension tracking system and, of course, the pension dashboard. I think everybody recognizes how important they will be for European pensions. So thank you very much, the presenters and the audience. George, back to you.
Thank you, Nikos. Thank you for chairing this session in such a professional and excellent way. And thanks again to all three speakers. As you may have noticed, we have a very coherent program, both within the session as well as across sessions, because we have designed the program in a way so that we have continuity. So tomorrow we're going to have another session which is going to build on what you heard today. And also we're going to conclude today with another distinguished speaker, Professor Vagianos, we thought that Dimitri would be an excellent addition to this conference because he's going to provide a case study, that of Greece, in terms of pension reforms. And this is because Dimitri has been one of the members of the Pissaridis committee, which has authored a report for the path to economic development for Greece. And as part of this report, the committee expressed views on pension reforms. I should say that Dimitri is a professor of finance at the London School of Economics. He holds a PhD from MIT, and actually he had served in the Faculty of Finance in MIT until 2004, when he moved to LSE. He's a well-renowned scholar. He has many distinctions. He has published in the very top academic journals, and it is really an honor and pleasure to have Dimitri with us. So Dimitri, the screen, as Nico said, is yours. You will have 15 minutes, and then we'll have about another 15 minutes for Q&A. So for the audience, please feel free to submit your questions. Thanks a lot. Dimitri, we cannot hear you.
Can you hear me now?
Yes, excellent. Thank you.
Thank you. Sorry about that. Okay. Is my screen visible okay?
Actually, we can see both your current and the next slide. So you may wish to switch just to the current one. It's up to you, really.
Yeah, but I don't know how to do that. Okay.
No problem.
Let me off. 1 second. Let me just try to see if I can fix that. Otherwise, yeah. All right. I guess. Fine. Let me try. Okay. Let me up. Okay. Fine. Let's just live with that. So, so I'm not sure how to do it. Okay. So thanks a lot for inviting me to present to this very interesting event. So, okay. So let me just go straight to the meat of my presentation. So essentially, I have divided the presentation into 3 parts. First, I will give a very quick overview of the current kind of state of the Greek pension system. Then I will talk about some international evidence about how a switch towards pre-funded pensions, kind of a large kind of pre-funded pension pillar, kind of how does it affect the economy and especially the financial system. And then I will comment about the new reform that is being kind of undertaken right now in Greece and kind of some of the issues around it. Okay, so as we all know, the expenditure in Greece on pensions, on public pensions, is quite large. Greece is the first in the Eurozone in terms of the expenditure. So it's 16.1% of GDP, and for against the 12.7% Eurozone average. So and kind of quite importantly as well, a significant part of this pension expenditure comes straight from the general budget. Now, during the adjustment programs, this the pension expenditure kind of was put on a more sustainable path. It was reduced, and it was put kind of assuming kind of everything goes according to plan, that it would kind of decline further as a percentage of GDP over the next several years. And also, very importantly, pension entitlements were made more uniform across the economy, kind of to eliminate or reduce significantly pockets of privilege. So now, what has not changed through these adjustment programs, and is in the process of being changed now, is that the system has essentially remained almost exclusively pay-as-you-go. So as also the previous speaker said, the kind of almost all of Greece's pensions are through the public pay-as-you-go system is 95% of contributions into that goes into that. So by the way, this figure and the next come from the Pissarides report, the growth plan for the Greek economy, and I will refer to that also a bit later as well. So anyway, so now the other aspect of the system is that contribution rates are very high, and the kind of to this kind of pay-as-you-go system. So if we count both the basic pension and the auxiliary pension, the Greece ranks kind of very high up in terms of how these are. Is 26.5% of gross salary, is about 8 basis points more than the OECD average. So okay, so just to summarize what I just said in the previous 3 slides, so the current system relies excessively on pay-as-you-go. Pension entitlements remain high on average. As I showed you, kind of the Greece right now it has the highest pension expenditure as a function of GDP in the EU, and mandatory contributions are also correspondingly high. So this is a problem, has adverse effects on production incentives, because it's a kind of this is perceived as an important tax on firms, especially given the perceived lack of reciprocity between contributions and future pensions, and the situation is expected to become worse because of demographics. So a shift towards pre-funded pensions is necessary, and occasionally we'll be using private pensions as well, just private in the sense that they are perceived as being owned by the individual who contributes. So because this kind of with pre-funded pension, there is more kind of there is perceived reciprocity between contributions and pensions. So so this kind of the change will with this change, the system will be perceived less as a tax. And as we have heard also from the previous speakers, the whole world is going towards this direction. Actually, I did not say when I said that Greece has 95% of contributions are in the pay-as-you-go. The comparable figure in the OECD average is about 50%. So the kind of Greece lags significantly behind the kind of other advanced countries in that regard. So it's kind of good time to move in that direction. It's very important. Now, what I will do next, I will talk about some international evidence about how a shift towards pre-funded pension affect the economy. So in some sense, this would be a bit complementary to the arguments that I made earlier about better incentives for production in the economy and dealing with demographics. I will also talk about kind of how this affects the whole structure kind of the economy. And especially of financial intermediation. And the figures that I will show you come from a very interesting work by David Sharfstein on kind of his presidential address to the American Finance Association a few years ago. So I will show you lots of graphs like this one here, showing different aspects of a switch to pre-funding. So first of all, the kind of countries that have more private pensions, for example, like Netherlands, Denmark, Australia, kind of Iceland are in the forefront of kind of have the most. You can see them in the top left corner of this graph. While, for example, countries that are much more reliant on pay-as-you-go are Greece, Italy, Spain. So, so the overall kind of amount of pensions is not very different. It's just that a private substitute for public, a private substitute for public. So what is plotted here is the public replacement rate versus the private replacement rate. Now, what changes a lot is pension assets, which increase very significantly. You see kind of in the countries that have the most kind of the biggest kind of share of private pensions, pension assets are about 150% of GDP. Kind of this includes Canada, that we heard before from a speaker, includes the Netherlands, we heard as well. So now the overall replacement rate is approximately independent of the public versus private mix. So in this figure, you see like a country like kind of Netherlands that is primarily kind of private based versus a country like Spain. They have which is primarily public based. They have a very comparable replacement rate, but they have a very different mix of kind of the way the system works. Now, what changes? And lots of other interesting aspects of the economy change. First of all, with and this is really what I want to emphasize here. So the moving more into private pensions obviously brings an increase in pension assets, as I mentioned before, but also is associated with much deeper, bigger capital markets, both the market for stocks and the market for bonds. And this is obviously the local stock market, the local bond market. So the idea being that kind of this, the savings that private pensions mobilize are invested in these markets, and they kind of contribute to the growth of these markets, kind of more liquid, larger. The other very interesting aspect is that the financial system becomes less bank-based. So this is what is plotted on the y-axis here is the share of bank loans as a percentage of total corporate debt. On the x-axis is the amount of the public pension replacement rate. So how the importance of public pensions, in other words, in the country. So with more kind of private pensions, more to the left of the graph, capital markets play a more important role, and some of kind of corporate access to credit, to finance, goes more through them and less through banks. What does this imply? One implication, kind of somewhat indirect, but is very important, is something that we really emphasized a lot in the PISA Readers report, which is that the firm size kind of is associated with a larger firm size. So you see that the kind of countries that have a bigger fraction of private pensions are typically have fewer small firms. That's the graph in the left, more large firms, the graph in the right. So and partially because banks may have more market power in some cases, that kind of may prevent the growth of firms, partially because banks may find it may not be willing to take very large exposures in large firms because of diversification considerations. The other,
Dimitri, sorry for interrupting. Is it possible maybe to put a full screen mode so that the graphs can be a bit more visible?
Yes, of course, absolutely. Let me try to see how to do that. I can maybe this one, no.
Maybe getting out of this mode and then clicking the view full screen would help.
Yeah, let me see how I can do that.
Sorry for that.
Yeah, no, you're right, and somehow it bothers me as well. So let me see how. Okay, 1 second. 1 second. Okay, why doesn't it let me do that? Okay, let me try to get. Okay, so again, you see now my. So how about, is this better? It's not the first best, but is it better?
That's better. And actually, if you go to view, I believe if you go to view on the up, yeah, there, it should have somewhere full screen or.
Let me see.
Or actually, it's on the very bottom. If you go to the very bottom, and you have on the right an icon, if you click there, that's
slideshow. This one.
Yeah, that's one. Yeah.
This is what I clicked before, but I got this.
You got that one. Oh, I see.
So how about if I 1 second? So yeah.
Yeah, let's do it with the second best that you had at least, so which shows okay, I guess.
Yeah. All right. So yeah, sorry about that. Somehow I don't know how to get it better. All right. So okay. So I was talking about firm size. That so kind of is associated is associated with kind of these larger capital markets are perhaps not surprisingly associated also with firms being able to grow more, and so a larger fraction of large firms, those that have 250 plus employees, and a smaller fraction of very small firms, those, for example, from 1 to 9 employees. Now, another aspect of large capital markets is what I show here in this slide, which is that the countries, again, with more private pensions have smaller fraction of insider ownership. So, in other words, there are more. kind of the firms are less owned by the kind of the main shareholder or the founder. So why is that? Kind of how does this relate with the capital markets again? Is just because insiders can sell their shares more easily in more developed capital markets, which in turn means better corporate governance. Now, of course, this is this assumes that the larger capital markets go along with the strengthening of the capital markets regulator. So, and there's not a graph on that, on kind of the kind of various metrics pertaining to the capital markets regulator, but one can imagine easily that this is the case. So that okay, so now 2 more graphs, and then I will summarize on that aspect of the presentation. One graph concerns the housing equity. So you see that in countries that have more pay-as-you-go, like Greece, for example, in the households hold the more housing. They hold kind of larger, the housing equity is a larger fraction of their net worth. Why is that? Just because they hold less, fewer financial assets. They're kind of through their pensions. So the capital markets are not as grown, partially because pension assets are not as grown, and so they do their savings more through their houses, which is a bit of a problem because housing is a kind of more illiquid form of investment and less diversified form of investment. And finally, and perhaps a kind of a bit of a corollary of things that I said before, the countries that have bigger pension systems, more private pension systems, have also larger financial systems. So the financial system as a whole it just grows. So this is the finance share, and finance share is the value added by the financial sector divided by GDP. So you see generally that this is larger in those countries that rely more on private pensions. So just because there is more demand for financial services, the financial sector becomes more sophisticated. So let me just summarize this part of the presentation. So basically, okay, so countries that have this larger kind of pre-funded, that rely more on pre-funded pension pillars, have larger capital markets, just because they kind of all the savings that go through these private pensions. And this has a number of effects in the economy that we think are on the whole beneficial. In particular, they have larger firms with more dispersed ownership, so better risk sharing in the economy. Households, in the same spirit as of risk sharing, households there hold more of their savings in financial assets rather than equity. They are the shareholders more in the firms and in the larger firms, and also have larger financial sectors. Now, of course, you can argue that, okay, maybe here I'm just showing you correlations, I'm not showing you causation, and this argument has some merit. However, okay, and this was a presidential address to the American Finance Association, so it involved some kind of work in the background, and the author did some kind of control for a number of factors that could drive a correlation, omitted variables, so to speak, that could drive this correlation, and found that pensions seem to have an effect on their own as well in this graph that I told you. Perhaps not as big in some of these graphs, but certainly there's an distinct effect of pensions. Okay, so George, can I have like 5 more minutes? Is that okay? Or how much time do I have?
You have 3 minutes.
3 minutes, all right, I will finish in 3 minutes, no problem.
Thanks.
So let me finish with some kind of comments and assessment about Greece's new pension reform, and we can talk more in the comments if you wish. So now, the pre-funded pensions in Greece are provided primarily, right now they're provided by there are some pensions provided by the private sector, which can be firm level or occupational level products, or can even be individual level products. So people can buy an individual pension by insurance company. So there are some tax distortions in that kind of group of products. For example, kind of products offered by insurance companies are kind of taxed more heavily than some of the other products. They kind of the individual level products are taxed more heavily. Now, the big change is that, as we all know, is that now the state has come into this pension provision, and this is a new law that was voted in 2021, a few months ago. Kind of has a second pillar has been established. So what are the key features of this second pillar? So it concerns the auxiliary pension only, kind of, which is about 20% of the current pay-as-you-go. So it's relatively is not a very big part of the pension. the contributions are mandatory, kind of essentially the contributions to the auxiliary pensions have to continue the same way, and the people have to pay the full contribution. It's open to the new entrants to the labor market, and optionally to those others below 35 years of age. Contributors can choose between different levels of risk. There is a single state provider who can contract with private asset managers if they wish, and the state provider guarantees also a minimum pension. There is this provision in the law. So let me just say a few things about kind of an assessment, an early assessment of this change. So certainly we view this as a positive development for all the reasons that I went through so far. Kind of the advantages of kind of pre-funding, given Greece's current situation, but also given the international evidence. But I think there are some important concerns. First of all, the move to pre-funding, and this is my last slide, George. The move to pre-funding is too slow. Has been essentially it's only for the auxiliary pension, so a small fraction of people's pensions, and only for new entrants to the labor market. So it's a bit too slow, kind of given how much of a need there is to switch to a move kind of to more pre-funding a system with elements of pre-funding. So then another thing that I think is problematic is that there's a single state provider. There is no competition kind of with other private providers. So this kind of makes the system more open, kind of at risk of political interference. For example, there could be the risk that the state provider decides to overinvest to put too much money into Greek government bonds because, I don't know, they need to finance the deficit, or in, who knows, in politically connected firms. So I think an issue that I think should be given serious consideration in that context is that perhaps it can be useful, at least in the first stages of this process, to invest primarily in passive, funds, passive investments, given that after all the system must prove itself, overcome some people's lack of understanding of financial markets, overcome significant political opposition. So, and to really show what are the main advantages of pre-funding, which is diversification and transparency. And diversification and transparency are achieved by passive investing. Of course, one could potentially do better with active, but there are risks there. Perhaps one could kind of keep a small fraction invested in active and gradually raise this over time. So then the state guarantee to me seems a significant problem. It distorts risk-taking. How can it be consistent with the idea that people can select multiple risk levels if there is also a guarantee on top? As we know in finance, if we can choose with a guarantee, we have an option, and we want to maximize the volatility of the option. And finally, and last but not least, as I said earlier, there is a very important need to strengthen the capital markets regulator to accommodate the increasing role of capital markets that the second pillar will usher forward. Okay, let me stop here.
Thank you, Dimitri. Thanks a lot for the stimulating presentation. Let's take some questions from the audience. Okay, I see. Let me try to see if I can streamline them somehow. So one question is the following: you have drawn clear conclusions from international evidence on how pension funds can positively impact the economy. In your view, how does the design of the new Greek pension system called TECA score against this evidence in terms of being optimized to have the most positive effect on the economy?
Well, okay, so I would say a balanced answer to that. I mean, I think there are pluses and minuses. Certainly, TECA kind of achieves the important benefits, some of the key benefits of pre-funding that I described, which is kind of, there will be a gradual build-up, perhaps a bit too slow, but a gradual build-up of pension assets, which will gradually lead to a kind of increase in the size of capital markets. I think this process might be a bit too slow. But as I said, at the same time, so we're going to reap some of the benefits. At the same time, there are important kind of pitfalls that concern me, that certainly I would like to see a very rules-based investment, at least for the beginning, to avoid kind of these potential problems and the kind of a deterioration of trust in the way this investment markets work, or the investment process is going to work. So anyway, so I have a bit of a mixed view basically on that.
Okay. Actually, I have a question. As you know, the switch from the pay-as-you-go system to the capitalized system, represented by TECA, creates a financing gap for the members who still stay in the old pay-as-you-go system. Now, the argument here is that, the optimistic argument is that this gap can be financed through the growth of the Greek economy without putting the burden on the taxpayer. Given that you are also a member in the Pisaridis committee, would you have any views on this?
Yeah, sure. I'm happy to comment on this. So I think the important thing to understand, and somehow I think this discussion about the financing gap kind of has not fully acknowledged at this point, is that in a sense, these liabilities that exist in the pay-as-you-go system there are future liabilities of the state. Essentially, the state is promising to future pensioners that is going to pay their pensions. How is going to pay their pensions? It's going to pay their pensions by getting contributions from the future workers. But it's a promise of the state. Now, the state is telling to the future workers, okay, you are not going to pay the future pensioners, but you're going to put your contributions in for your own pensions. So now, but it's still, I mean, the state essentially has still made this promise. It's still a commitment by the state to pay these people in the pay-as-you-go system. There is kind of this hidden liability of the state. In other words, this is what I'm going to say. It's not that now we're creating a new kind of a new extra liability for the state. This liability was there. So and precisely on the basis of this point, there are ways to make the switch from pay-as-you-go or a part of pay-as-you-go to the funded system by this, for example, the state issuing to the new new kind of workers in the future a promise that kind of essentially it says, okay, give me your contributions, and I will use your contributions to pay the retirees kind of in the pay-as-you-go manner, and I give you bonds. So in other words, we're not changing really anything in the system. I mean, essentially, these are called recognition bonds. This solution has been done in a number of countries where that has done this switch. Essentially, it involves an increase in the public debt. It's an increase in the public debt just simply by relabeling state liabilities that existed already. We just make them kind of more explicit. We put them in the public debt as opposed to putting them in kind of hidden in the pension system. So, of course, we're not going. This should not be done kind of a one-to-one replacement, because the system has to start building kind of gradually capital, kind of that is not just obligations by the state. But my basic point is that yes, and okay, and this will be done. This build up of pension this build-up of pension assets, of course, will have to come with kind of the state kind of taxing a bit more gradually over time, or perhaps there can be a dividend through the growth of the economy, as you said. But the thing that I want to say is that it's a fallacy to believe that the state has to do two things at the same time, has both to pay the pensions, the current pensions, and also to anyway, the state has to pay the current pensions, because the new workers are going just to save for themselves. The state can do this switch quite gradually, and so this is totally something feasible. It's just a matter of acknowledging kind of the debt that exists in there.
Okay, thank you. Let me take another question. Okay, here is an interesting question. You state that the diversification and transparency are achieved by passive investing. This is true over the past 50 years. However, market performance over the past 10 years shows that the diversification achieved is actually extremely low. Any thoughts on that?
Okay, so I'm not sure diversification. I mean, passive investing by definition is holds kind of the whole kind of a broad market portfolio, a broad portfolio of assets. So I'm not sure in what sense diversification of kind of through passive investing is low. I mean, certainly there are some big firms in the, I mean, Tesla right now is a big chunk of the market, but it's not, is I don't know, 3% or whatever. It's not, it's small in relative terms. So, I mean, let me say that, sorry, yeah, George,
yes, I guess the question may have in mind that diversification may have been low because correlations may have increased, and even though you may be investing in something which seems to be diversified, maybe it's not after all.
Well, okay, so yeah, well, okay, certainly, but you know, I think that at the first approximation, look, the question is, what do we want to achieve with this move to the pre-funded system? We want to certainly give Greek households kind of access to an efficient portfolio. Kind of this is what finance theory says, and an efficient portfolio is not exactly the market portfolio, the portfolio of all available securities in the world. But a passive portfolio approximates that. It's certainly better than holding investing their contributions and their contributions being invested kind of in the pay-as-you-go system. So I think we want to give them a kind of some exposure to the benefits of the equity premium, so to speak, in a fairly diversified, low-cost way. So it's true that perhaps, yes, there is some correlation between countries, but okay, that's this is the kind of still, I mean, it's still a pretty efficient portfolio. Now, I'm just a bit worried of kind of going to kind of a significant part being active, and then they are kind of, I don't know, so for some reason it underperforms some benchmark, and then there are political accusations that they kind of where this is being invested irresponsibly, or there is some potential interference. So this is why I think it should be made as rules-based as possible, at least for some initial, for a few years to get it started and build some trust.
Yeah. Actually, what you say relates very much to a question posed earlier to one of the speakers, that under the new rules, if TECA invests in Greek bonds, then these Greek bonds under the Eurostat rules are not going to count towards the Greek debt. So this creates a motive, if you like, for, for pressures from the government to the asset management of TECA to invest in bonds, in Greek bonds, which may be suboptimal after all. So what you say really ties nicely, because you propose a rules-based approach, which could circumvent this kind of problems.
Yeah, I very much would like to avoid this kind of this instance. I mean, it would be horrible that it invests in Greek government bonds, and then kind of the value of these bonds goes down for whatever reason. So it should be kind of fairly rules-based, that is kind of based on, how can I say, sound principles of financial investments, as opposed to kind of, yeah, potential problems of interference from left and right.
Very well. I think we have time for one last question, if you're not too tired. Let me see which one. Right. Okay. The new Greek system you describe has a very long-term horizon at this point. Does the law allow to take maximum benefit of this long-term horizon, i.e., in view of the comments made earlier by Edward van Gelderen and the international evidence you have shown?
That's interesting. Look, if I understand correctly, this question, I think is a very interesting one, which has to do about the horizon in asset management. Like this, the previous speakers have emphasized it, and I'm very sympathetic to this kind of idea that the asset managers should have a long horizon. And I'm kind of doing research on these very issues, actually. So now, so ideally, what you would like to do in a first best world is that you would like to tell this manager, you would like to have the pension provider to contract with asset managers, and to give these asset managers a fairly kind of broad mandate, say just pick assets, investments that you think are kind of undervalued, that kind of give a high long-run returns. And I will not evaluate you after 1 year or after 2 years. I will evaluate it after 5 years, or kind of so that somehow you give them, you can give this kind of this horizon to your managers, and also even the trustees of the fund can have a long horizon themselves. perhaps, I mean, as well, so that somehow that they can feel they would be able to better take advantage of opportunities in the market that can take some time to pay off. Maybe some kind of illiquid, invest in some illiquid assets. So I think this can be a desirable feature. Just I'm not quite sure how to achieve it kind of in the current setting. In other words, my comments earlier about not giving enough discretion is in some sense going the opposite direction, because I fear that I mean, there's a bit of a trade-off somehow. If you want to give them a lot of, if you want them to take long horizon investments and to invest in this kind of illiquid markets, you need to then, okay, you also have to tolerate that there may be some things that can go wrong. And perhaps given the current level of trust and given that very much of what is every kind of issue in Greece, even technical issues, become a kind of political issues, I think that it might be better, at least I think at least at the beginning, to start with a very rules-based approach and gradually perhaps give more and more leeway, and kind of this gives some more active mandates, and active mandates should also come with a longer horizon to be effective.
Yeah, actually, I think this what you've just said speaks nicely to a question, the last question which has just come up, which is pretty much a rhetoric question, says an efficient portfolio with a 40-year horizon should be 90% equities. Is it realistic for the new Greek pension fund TECA to invest this way?
Yeah, that's precisely the point. I mean, because if this portfolio of 90% equities like underperforms massively in I don't know, in the next 2 years, it would be like a big fuss, and not to say, I don't know, like one may want even to have a portfolio allocation towards values stocks kind of more, which is also this efficient. So for this, yeah, I mean, of course, I think in some sense people could choose their level of risk, especially if we don't have this guarantee that I don't really understand its purpose. People could choose different levels of risk. So in some sense, they could choose to have more or less. I would give this choice to actually come back to this question. I would give the choice of how much equity to hold to people, assuming that the law, I think the law allows for this kind of different levels of risk. So as long as it's between some kind of bond index and some equity index, I would say some world equity index and some world bond index, I would give this choice to people, to the future pensions. I mean, after all, with a bit of obviously some education, some comments, some education, some explanations about how this investment works. What I'm more against is investing in kind of different segments of the market within that this index. So this is where I would try to keep it a bit more simple.
Great. I think we're running out of time. The guarantee is a very interesting feature, and actually it is a big challenge, I think, for the new fund, because obviously if in the unfortunate case is going to be triggered, then the taxpayer is going to pay about this. So, yeah. But anyway, Dimitri, it was a real pleasure, hearing your presentation and discussing with you. Thank you very much for being with us. And I would like to conclude the first day of the conference and thank once again all speakers, and thank, of course, the audience and our sponsors. Tomorrow, we're going to have another fascinating second day where we're going to build on what we heard today. So tomorrow, we're going to talk about strategies. And we're going to conclude tomorrow with another exciting panel, which is going to be moderated with a real expert, Mr. Theodore Economou, who will be coordinating really expert panelists. So please stay with us tomorrow. We're looking forward to seeing you. Good evening or good morning, depending on where you reside. Look forward to seeing you tomorrow. Bye-bye.